the day is I'm calling up on Ms.Jyotikka, COO of Enterprise Tiger, to present her topic on Entiger 360-degree Delinquency Management System and Digital.Ai. Ms. Jyotikka is a Chief Product Officer for Enterprise Tiger with over 20 years of experience in change management in the area of retail lending, specializing in debt management. Firm believer that creativity, technology, and mediation is the mantra to a better world. Is Ms. Jyotikka around? Yeah. Welcome, ma'am.
The correction, that was meditation. I'm a firm believer in taking creative risks, doing a lot of meditation, and keep your juices flowing. That's all. Huh? Okay, so we're all up and about, right? Can we have maybe a show of hands or something just to stretch ourselves? Yeah, let's just stretch ourselves a bit. It's morning, it's fine, right? Okay. Let's just take some good vibes in from everybody here, yeah? I'll actually begin with the presentation, right? So my name is Jyotikka, and like she introduced me, so I've been running a startup called Enterprise Tiger since the last 6 years. We are 3 co-founders that are there. I'm one of those 3, okay? So I have to give credit to both of them also, who couldn't be here. And what do we do? So we run a delinquency management system. So to the banks and financial institutions, we sell a debt management solution where we help the bank collect money from customers who don't pay, right? Specifically in that particular area. Now, why do we do this? So 2 of myself and my CEO, both of us come with a debt management background and more. So for about 15 to 20 years between us, we've been working for banks and FIs. And then we got together and decided that this is one space where no technology firm is actually building anything for the banks and the FIs. And because we were on the other side, we could make good decisions in terms of what kind of a product we wanted to make. And therefore, we were lucky to have a lot of success as soon as we started. In today's presentation, what I'm going to focus on is that AI, machine learning, digitization, digital transformation, everybody is talking about these things. But these things are very difficult to achieve because there's a major change that is required to achieve this. In today's presentation, I will keep my focus on how to make these things easier for the banks and the financial institutions to adapt to them or to use them. It's easy to make a technology. It is another ball game to get the users to use that technology and create the return on investment. So my presentation today will be focused on that, right? I've already given you an introduction of the company. I am still waiting for them to put my presentation up, right? That's technology for you. It's there, but it's difficult to use it, right? This is after the fact that I came in the morning and I actually tested it, that everything is working. Okay, great. Okay, so I will move on to hold your interest in. There's a very interesting series of books called The Fish Sticks. Very easy to read, like it's easy reading. One of the things there they explain is that the easiest way to change or the easiest way to make people change from one way of thinking or doing things to another way of thinking and doing things is to keep it natural. So imagine if today all of you sitting here, for some reason, all the chairs would have been broken. Asking all of you to stand wouldn't be the most natural thing to do. The most natural thing to do would be, okay, let's just sit down. Alti palti maro, niche baitho. Let's continue, right? So the easiest way of bringing about change is to keep it natural. There are live examples in all of our lives where you can see this, right? So the first time Motorola came up with pagers, best to see while I'm talking, okay. So when Motorola, so I'm just doing a quick recap. So the easiest way of getting people to change is to keep it natural. Live examples, Motorola, when they came up with pagers, the natural thing was instantly. If you have a problem, you want to share it instantly. You want somebody to do it, share it instantly. That's why people moved from landlines to Motorola for messaging. Similarly, Nokia introduced the fact that I like to hear people. And I like to hear people while I'm on the move. I don't want to be sitting near a landline waiting for a call to come. And therefore, Nokia could motivate billions of people to move from landlines to mobile phones, even though they were very expensive at that point of time. Similarly, when BlackBerry came, they said, we like a conversation. If I say something, I get a response in return. And therefore, BlackBerry Messenger single-handedly made this, according to me, fairly ugly looking device with a QWERTY keyboard which had really small keys. I wonder how we used it during those times, right? But they still made people buy a very, very expensive BlackBerry phone to this extent that even companies were giving it to their employees. And then when iPhone came with the concept of touch, we shake hands, we take cards, that's what we've been doing here, right? So touch was introduced. So similarly, our mantra at Enterprise Tiger is that whatever technology we make, we move into the natural tendency of doing things. Now, how do I do debt management and how do I introduce artificial intelligence into debt management? If today we go to any of our collection managers or collection executives or collectors, the first thing they will say, oh, this is not going to work. Even regional collection heads will say, oh, this is nonsense. Artificial intelligence cannot help me collect better. Every customer is different. That is one line they will use everywhere. In fact, those of you who are in management would hear, every region is different, every city is different, every product is different. And therefore, you cannot automate how to collect. What do we say? We say, yes, every customer is different. There's no debate. Every customer is different, every region is different. Now, what do we do in our AI? Since the last 6 years, we have collected information about 1.5 million transactions that have been happening on our system. There are 200,000 people who use our application. Their behavior, the behavior of the customers that they service, we understand that data. From that data, we are able to understand the customer profile, their payment behavior, their engagement behavior with the collectors. So, how often, if I go and knock the door twice, how many times do they open the door? If I go and pursue them for a payment, how often and when do they make the payment? So we have all this information on an anonymous level at customer personas. Using this information, we made data models, and those data models are then covered up with AI to decide how to pursue each and every type of customer to get them to pay the money, right? Now, I am giving this presentation with a bit of a handicap, so I need you all to support me, okay? Any one of you who can tell me what is the traditional flow of collections? So if a customer becomes delinquent, what do we do? Do we send reminders? Is that the first thing we do? Can I see a show of hands, right? What would be the second thing we do? We send reminders, people don't pay. What do we do then? We call them. Brilliant. What is the third thing we do when even after calling they don't pay the money? We do a door knock, right? Even after doing multiple door knocks, if they don't pay the money, what do we do? Brilliant. So you guys are already chief risk officers, right? So it's already, that's what we do, right? So we'll do legal or repossession based on the kind of loan it is. Now, what we are offering here, or what we are saying should be done, is the following. And we say we want to revolutionize it. Why should I need a revolution? Things are going well. There's no bank, not even public sector banks now say that their NPAs are too much, right? Why do I need a revolution? Do we know that India's private credit is 65% of their total GDP? And what is the correct ratio for this? Good developing countries with growing economies typically have 125% of private lending or private credit, as we say, versus the GDP. And where are we sitting at? 65. All government policies are now indicating that they have to change and correct this ratio, right? Which means what? From 65% of the GDP, I have to take private lending to 125%, which is almost 100% increase. 100% increase will mean that the lending is increasing by 100% in India. In India, these are all India-specific numbers, right? Now, why is it that the banks are not giving? They take awesome rate of interest, anything between 8% to 24%, right? Why is it that the banks are not lending more? Any guesses? Why is a bank not lending more? The government wants them to lend. That's a good business. Why aren't they lending more? NPS is one thing. The other thing is also that they are not as agile, and that's why fintechs or lending fintechs are growing so much. So both these reasons are there. They are not agile to sell loans, and they are very worried about their NPS. Now, when they are very worried about the NPS, technology or intelligence that will support them in the lending will always grow and will need a revolution for it to grow, because it's not that, oh, increase it by 20, 25%. We want lending to increase by 100%, right? And therefore, in the space of debt management, we need a revolution. We can't do with small changes, small digital transformation, introducing technology that improves productivity. That won't do it for them. They all have to increase by 100%, and therefore a revolution is necessary. 10 years back, if I told you all that we would do telecalling to do collections, what was the first reaction? Oh, that's nonsense. That won't work. I call up someone and they will pay. Those who don't want to pay will never pay. Calling them will not help, right? That used to be the typical reaction we would get from people. But today, telecalling is a norm. It's a norm. All of you sitting here, even those who are not doing credit and risk, know that telecalling is the first step, right? Similarly, digital collections or personalized digital collections is going to be a norm in the coming 3 to 5 years, because that will revolutionize how collections is done. Take a very simple example. If you're sending reminders to 100 people, 50 will pay, 50 will go to telecalling. Out of the 50 that go to telecalling, 40 will pay, another 10 will go to field. Out of the 10 that go to field, another 5 will pay, right? 5, maybe 6 will pay, right? And the rest go into legal, which is a black hole in India. It sucks up more of your money than really get you the money back. So therefore, we bring a new way of doing collections, which is what, because I'm still handicapped, so between the traditional reminder and telecalling, we introduce another way of doing collections. And what is that? The digital collections, where we do personalized messaging, right? I have everybody's attention. So we are talking about digital personalized messaging to delinquent customers. Let's take an example. Suppose you miss your credit card by 5 days, right? At the same time, which is natural, you might be traveling, you're here in a conference, you miss it, right? At the same time, your wife or your son is applying for a new car loan, right? His score will be affected. Why? Because you're overdue on your credit card, right? At that particular point of time, if I send you a message saying that while applying for new loans, your credit score is affected, pay your credit card bill right away, click on this link. If I send a personalized message like this, then you are highly motivated to make that credit card payment immediately directly to your credit card provider. Am I right? Correct? Similarly, look at another scenario. This is from the point of view of the bank. We also provide early warning systems. What do they do? So for example, you're a great customer with, say, an IDFC bank. Okay? But other two loans with some other banks, you're not such a great customer. You've missed your installment by 3 months, 2 months, 1 month. Right? What our system lands up doing is we give an alert to IDFC bank saying that there is an early warning on this customer. This customer has a great profile. He's been paying your loan consistently and diligently, but he has 2 other loans where he has already started to miss his installments. Oh yes, thank you so much. Can you move to slide 9? I think we can just move there. Okay. Okay. So we land up giving an early warning signal to the bank where they know the behavior of the customer for payments, even if they are not misbehaving on their loan with that particular bank, right? Yeah. Okay. So this is all the information that we have about the customer, using which we are able to slice and dice the personas, and we stick to the simple fact, and we do not debate with your traditional collections team, and we agree with them and we say all customers are different. We go with that. We are trying to keep things simple, right? What in turn, now, why are we able to slice and dice each customer and do personalized messaging with them? Because I do it digitally. If I ask your collections team to slice and dice a person at each person's level, they can't do it because they can't do it on an Excel, right? Correct? Therefore, we do it digitally using the data models and AI that we have. Now, on this slide, what I've done is I've tried to give you a flavor of what we do. We have millions and millions of personas. We don't have 4 personas like given here. For the purpose of understanding, I'm giving it at a very high level, right? So you may have customers which are self-cure customers. They just need a reminder. Somebody who's just a short-term relief seeker. Somebody who's distressed, or somebody who's evasive, right? So what we do for them, and just pay attention at these blocks here, all the blocks which are a light yellow and a green, they are all digital boxes. That means there is no human intervention in it. So based on the different types of personas that you see, we can actually do personalized collections without any human intervention. And naturally, there will always be a stage. Say when we talk about DPD 91 plus, which is recoveries really, right? Or when the cases are about to be written off, we may need a human touch there. So I am not brash about the fact that the human touch required is 0. No. It is required. A hybrid approach is the best approach to get you your efficiencies here. It's your best approach to be confident enough to say that I am going to increase my lending by another 100%. That's the core thing that we are trying to address here. We are trying to enable the lenders to increase their lending by another 100% because we have your back here. We have your back where collections is concerned, right? So if you, the normal collection flow is delinquent accounts. The change that we bring is simple. We do super micro segmentation. That's the key thing here, the second icon in the middle, right? So super micro segmentation done completely digitally, right? This is how we land up curing customers. Now, in the traditional workflow where I was, step number 1, send them some reminders, right? And then we used to move on to telecollections. Now we don't move on to telecollections. We move on to the personal messaging that you see here in the center, which could be emails, messages, WhatsApps. understanding the responsiveness of the customer on WhatsApp. When does he read it? When does he read an email? Robotic calling. We send payment links. There's a web portal where they can access credit counseling. We can help them correct their credit scores, right? Then we move on to give them services. You want to check your balance? Check your balance also here. So they remain sticky with us. You want to update your address? Update your address with us, right? And so on to make easy payments. And naturally, sticking to the traditional workflow. If after this there are customers who don't pay, we continue with the traditional collection cycle. But this is here to reduce the load that may come on telecallers and field collectors with 100% growth in lending. Now, I spoke about this yesterday also. More and more banks and FIs will now ask us for result-based vendors or task-oriented vendors. We don't, and this is something all fintechs, I believe, are already doing or are starting to do. Banks will no longer come and pay hefty license fees for technology. They will demand us to be result-oriented. So even this kind of digital smart collections, what we say is only if I collect for you, you pay, otherwise don't pay. So it's almost like we are acting as a collection agency. Though we are technology vendors, we are providing technology, we are running that technology, but the mool mantra here is that you pay me only if I collect, otherwise don't pay me. We are confident about this to an extent that we are saying any bank and FI who wants to try out this, right? Though we are offering it to very selected people right now who are already our existing customers. But if there is anyone who wants to use this technology, from the month of Jan is when we open up for all other clients who are not currently our clients, is that the first 2 months we do free collections for you. Which means we will collect, but you don't need to pay me anything. That's how confident we are that personalized, smart digital collections is the way forward, okay, to solve a big problem that may hit us, which is we need to increase our lending by 100%, right? I'm open to some questions. Yeah, I have to take her permission. Yeah. So if you all have any questions, I'll be happy to answer on this. Yes.
Hi, good morning. I'm Vishy from Fintech.
Yeah.
So, 2 questions. Let me start with this. Pay as we collect. So, does that mean the infrastructure lies with you, or you will still rely on the bank's infrastructure like your telecalling team, which is actually, you can say that the telecalling can happen for this account, but somebody has to physically do the telecalling activity, right? Is that with you?
Okay, so no, we don't do any telecalling. So I'll just go a slide behind. Where do I have to point it? Okay. So I'll keep this slide in reference to answer your question. So first question, our data models, etc., both models are available. Either we can do it on our premise and do the messaging with the customer, or it's like a plugin that we deploy on the customer's servers, and from there the messaging goes from their own message handles. Okay. So both ways are possible. Now, the second thing is, the fourth step that you see here, we don't do telecalling. We don't do telecalling. However, after the smart digital collections, what we call as Incredible, right? After Incredible, if there are customers which have not paid, the bank can push it to the telecallers as and when they would like to.
Okay. Yeah. Now the second one, when you showed the earlier slide, there was something about auto cures, right? 40-50% may get auto cured,
yeah.
right? So you mentioned credit reports. A lot of this information you will have to be dependent on the primary, the bank or the fintech with which you're working. They'll have to share you the credit reports. They'll have to give you customer traits. And if you have artificial intelligence, for example, you can say Vishy will only pick up a call between 3 and 4 on a Monday. Correct? Those kind of technologies, do you have that?
Yeah.
Or the primary,
no,
I have to give you that data?
No, we have that information already.
Okay.
Yeah. We have that information already. We independently have that information.
Including the bureau report and all.
Yeah, for the bureau report, we have to pay the bureau, which we will pay. That's part of my cost.
Your cost.
Yes.
Okay.
It's part of my cost.
Thanks. Looks interesting. I think we'll catch up.
Yes, sure. Yes, ma'am.
In the microfinance segment, does this work? Do you have an experience on that segment?
We do with a couple of our customers, okay, and the challenge actually in microfinance is majority of them are new to bank or new to credit, right? And that actually is the single largest challenger to what we are presenting here, and we are very conscious of it. So where it is new to bank, we rely on a different kind of information to do what we are doing. I'm just going to push it back to that slide. Okay, so this is the information that we typically use. This is a high level picturization of what we use. Now within the payment data, okay, and the trail data. What trail essentially means that when a collector goes and talks to the customer, how does the customer respond, right? So the payment and the trail data is what we use even for MFI customers who are typically new to bank. So their behavior also, this data helps me understand that behavior. So it's there is a reason why I went to selected customers of Enterprise Tiger when we started this, because we had 6 years of their data and their permission for us to interpret that data, right? So like I said, from Jan, when we start taking in new customers, right, there is a bit of a learning time, but what helps is that my data models are very well validated in the last 6 years and the last 6 months when we are actually doing these services for some of our existing clients.
So this is all for only retail lending, or I can think this can be replicated in other type of debt collection also?
Yes, I mean, theoretically, it can be replicated for other kind of products as well. But practically here, I mean, till now we worked only on retail models in India specifically. So it's India retail lending data models.
Not debt per se, but an institution if is into services for which there is an AMC charge. Now typically what happens in a brokerage industry, and when you open demat accounts, typically for the first year, the organization gives it for the free for the retail customer. So what people do is that they open an account, use it for a year free, then you know what, go switch the broker, again there use it for free. You know, they keep on jumping it. Now, technically from a brokerage side, you don't want to lose the customer, but at the same time, you don't want those AMC charges also to pile up and the customer not paying for it. So, can you also extend this for an AMC collection where there is no liability per se to collect it, but you need to collect obviously, otherwise you have to close the account?
Okay, so N-Collect, which is what we had launched in 2016, and we are market leaders and pioneers there. So N-Collect, which helps us do collections, is what can be used for AMC collections as well, right? And we did a very elementary and basic thing there, that for us, it wasn't a loan account on which we would collect on a customer. So if a customer had multiple loan accounts also, we were able to identify who that customer is, which now has become a regulation across multiple banks, that you have to look and assess or understand your debt not at a loan account level but at a customer level, right? So N-Collect, which is which was the first step to Incredible, the smart digital collections. So N-Collect is what can help you there for AMC collection, etc. Irrespective of whether it has moved from one broker to another, it doesn't matter for the service provider. Can I take any more questions, please? Good, good. Yes, ma'am. Yes, I do recognize you. Yes, yeah. I know.
As I said, we have a very wide-ranging set of customers, starting from very small ticket size loans to high ticket size LAP. If I want to use this service, in your opinion, which set of customer does it suit best?
Right now, based on our data models, it is most suitable for, okay, And when I'm using the word suitable, I'm going to define what suitable I'm considering. Suitable has to be something where my customer also saves money, right? And gets predictability in collections. That's what our mantra is, that we actually do debt management to bring predictability on cash flows and how and when should the banks borrow money to lend, right? And it should naturally save you some money, right? That's the whole agenda. So uh, it is suitable for small ticket loans because we are doing everything completely digital, right? It is more suitable there. But uh, I would like to say that it is a no risk proposition implementing it everywhere. I'll tell you why. Because I am not going to charge you if I don't collect. So for the lender, it's completely result based. Even it's in fact it's even better than your traditional collection agencies. To the traditional collection agencies, you say, oh, if you get me 40% rollback, then your incentive will be 30%, 20%, 10%, right? So there, even if they don't meet your targets, you still have to land up paying them something, correct? Unlike in our case, what are we saying? You cut one receipt, you pay me this money. You cut one receipt, you pay me this money. I don't cut receipts for you. That means I don't get the payment for you. You don't pay me anything at all, right? And because it is digital, I am also not creating costs. I don't have, see, one of the elementary mistakes some of the startups or fintechs do is that they come with a proposition which is not viable for the fintech itself. We don't do that. We are not doing that. We are coming with a proposition which is a win-win and it is viable for me. Why? Because I'm doing it digitally. I'm not employing 200 telecallers and 500 field collectors, and then when I'm not able to get the money from you for collection, I'm in a soup. That's not our model. So because we are doing it digitally, we might fail. I'm ready to accept it. Maybe on your lab portfolio I fail. But what's the harm? In 7 days you any which ways move it ahead to telecalling, right? So in fact, I really appreciate your question because it helps me explain one more thing. Unlike a collection agency where you have to give the account for 1 month and it is sitting there with them, for a digital smart collections, you have to give me the account only for 7 days. If I don't get it, move it ahead, right? So it is more suitable for small ticket loans, but it is no risk if it is tried across the complete portfolio.
A follow-up question.
Sure.
To assist you to do that intelligent messaging or reaching out to the customer, what kind of data would you require, especially from an NBFC where, apart from the repayment behavior of a customer, I don't have anything else to give you?
Yeah. So if you have trail data, meaning when your collectors had attempted those accounts in the past, that information can help us. And a detailed statement of account of the customer also, right? And what did the credit underwriter see when that loan was actually being disbursed? That level of information if we have. In addition to that, we will any which ways get the data from the bureau for each of them. That would be sufficient.
All right, thank you.
You're most welcome. Okay, good. We look good. Any more questions? Yes, sir.
Yeah, so just a very simple question. How long does it take the ML to kind of arrive at a persona for the, supposing I move my portfolio to you, and obviously at that point in time, you don't know any of my demographic profile of the portfolio, right? So how long does it take for you to build in a personas across the portfolio to fit in with one of your tested learning? So this is a difficult customer, this is a guy who does this. How long does it typically take? 6 months, 5 months? Because you need to, the ML has to somehow play onto the portfolio. You need to get learnings from that and then paste it on to what your model portfolios are, right?
Yeah,
so
yeah.
How long does that take?
So fundamentally, we need to understand something. Machine learning is a completely ongoing process. Tesla today versus Tesla 5 years back is very different and far more advanced, right? So the same goes for these data models. So, and the second fundamental thing that we have to understand is that we are doing the data modeling and ML for a India retail business, right? So the 6 years of information that we understand, right? The last 6 years of information that we understand is the last 6 years of time that has been given for the model to evolve, and it will continue to evolve. It will continue to evolve. It's not a process which will stop. Oh, I get a portfolio from X lender, and oh, in 2 months I will have a data model for X lender. No, it's not like that. The data model is for retail lending in India. So suppose a new client comes to me tomorrow, right? And I am unabashedly telling them 2 months, no charge, right? It is coming from a place that the data model has been evolving since the last 6 years, and we have been testing the model on already past information. Right.
No, I appreciate that.
Yeah. So there's no time really.
Yeah, no, the point is that ultimately in the workflow, you need to figure out person A is going to react like a person X on your core model, right? How long does it take to get that right at least? Because otherwise it will be starting off from zero and then seeing the efficiencies of the collections process that you're deploying digitally, and then saying that, you know, I think I have a fairly robust model now. Yeah. What is that time frame? I mean,
okay.
I come from
I cannot answer that objectively, I'll tell you. Okay. I will answer that from a gut feel of the experience that I've gathered. So according to me, it takes close to 6 months on a new type of portfolio to come with that. But which also means that on day 0 of that new portfolio, I will be using a data model which has been evolved in the last 6 years. Yeah, but I would say 6 months to it. Yeah. Yep. Yeah, so no, I haven't shared those numbers, but typically what we are seeing is till now, we've helped the banks reduce about 20 to 25% of their telecollection force. Now, again, that is not what directly happens. We don't reduce telecalling force by 25%. What happens is that during COVID, they were not as trained. Like the telecalling force was not as trained. And with their growing numbers, they are not having to employ more telecallers and field collectors. So about 20 to 25% is what we are seeing the results with us. Okay, thank you so much. And thank you so much for your questions. I really appreciate that and your attention. Have a good day, guys.